Hey tribe, stock market is up, but it's warning sign for you guys not to be too happy yet. In this video, I'll be sharing with you exactly why you shouldn't be too happy yet and what you should be doing right now. Now, the PPI last night, which is the producer price index, is announced and is slower than expected. What this means is for businesses, now the cost of production is not as expensive. So let's say I'm making a burger chain, I'm making a car production, and my supplies, okay, my materials are not as expensive as I expected. So this is likely to say that I will not pass on the price to the consumer because it's not as expensive. I don't need to increase my price so much to cover my cost. So overall, inflation seems to be in better control. Now, people are happy about this because this will compel Fed to reduce interest rate. Fed is increasing interest rate, holding it there because they are worried about inflation. So if inflation is slowing down, they are compelled to, or they are more likely to reduce interest rate. And this will boost the economy because businesses can borrow money at a cheaper rate. And that's where people are happy because stock market is likely to go up. However, even though stock market prices are up, this may be temporal in the short run. Now, let me share with you why. Number one key thing that I'm concerned about is the September effect. We are already in August. So this video is very urgent right now for you to understand. If you look at this particular historical data, look at the September month. It has always been negative. Now, let me go to the past 50 years. Most of it is negative. Okay, it's down by up to even 2%, 1%. This is huge drop, by the way, if you think 2% is not. Because if 2% compounded over the whole entire year, it's more than a 20% drop, which is a crazy kind of like drop in the stock market within 1 month. Now, let's look at 30 years. You can see most of them is drop. We have some years, okay, it is like 0.22% up, but most years is down. And usually, if it's up that particular month in September, August will be a down month. You can see that August, September, bundle it together, typically is a down month. Now, what is most important is this. Even though we can see that not all September months are down months, but what is very consistent is in the year 4 of the presidential year, which is this year, the election year, it has always been down month regardless. Let's take a look at it. 20 years, 30 years, 50 years, and historically, it's always a down month. Now, but why is that so? Why is September a down month? There must be a certain reason. Let's not go in blind. Let's understand. Number one, in September, there's this thing called the back to school effect. Now, in the US, that's where the kids go back to school after their summer break. You can see summer break is between like June to mid-August or sometimes to the end of August. So start of school is like 31st of August or 30th of August. So most of the US kids, students are going back to school, but so what? It means that there's less spending. Now, when kids are not in school, typically people spend more. Okay, so maybe they bring them for holidays, bring them out for eating. But once they're back in school, the spending patterns start to drop as compared to during holidays. Think about it for yourself, like during Christmas time or during school holidays. Do you agree that you spend a bit more? Wow, we don't like school holidays that much, isn't it? Now, from a monetary point of view, but from a, let's say, of course, family point of view, we love the holidays. So number one, because they're spending more, that's where all the indexes, okay, when there's less spending, all the GDP, all the like producer index, right, will be lesser. So when there's less production, there's less businesses, typically the economy seems weaker during September, and that's where stock market may drop. This is the number one reason for the September effect. Number two reason is called the mutual fund effect. Now, this is also very interesting. I found that a lot of the mutual fund, the bulk of it, their typical financial fiscal year, the time that they close their accounts is typically in about October. Okay, so near the year end. And interestingly, just before the year end, when they are closing their books, when they are really like tightening up and cleaning up their accounts, right, they will want to clock in losses for the year end. Why is that so? Because at the end of the year, when they report their earnings, they have to pay income tax based on the amount that they make. So during September, a lot of the practices that people do in order to save the tax. Now, this is beneficial for themselves and the investor. So don't see it as something like dodgy. It's not. It's a very smart move. In September, many of the mutual funds or even big corporate companies, they have the year end during that period, they will start to clock in losses, sell away stocks that is losing money. Because when they sell away stocks that's losing money, it becomes realized loss. It is actual loss. And when they have actual loss, their whole entire P&L, their profit and loss will look lesser. Okay, so they have to pay lesser tax. Now, it's a counterintuitive thing to most of you guys because say, no, I always want to show better profits. But think about it. Do you want to pay more income tax? They want to pay more corporate tax. So this is the second reason why there's a September effect. Now, the third reason, right, is a psychological self-fulfilling prophecy, because there will be like people like myself and people like other investors telling you, hey, September is going to be a bad month. Now, if you know that September is going to be a bad month, what is going to happen? You are likely not going to buy stocks. You're going to sell them off. And because you sell them off, that's why it becomes a bad month. So it's self-fulfilling. Now, why is there self-fulfilling prophecy? On top of the two reasons that was already covered, the next portion is actually psychological. So we can see that in the past, okay, there are very big like happenings in September, like the Black Friday, like September 11 or subprime crisis. Most of them happen during the September or even October period where we have Black Monday as well. So with all this, right, it comes a particular like fear in the market and they say, oh, you better sell. And if let's say everybody say that it's going to go down and you better sell, they will sell and it goes down. It's self-fulfilling prophecy. So now what do we do then? Number one thing that we need to do is, in my opinion, we're going to hold more cash. So even if you look at my account, even though we have been up by 40% this year, I'm holding about 50% of it in cash. I'm still committing some of them into buying S&P, buying UPro, buying TQQQ, because now it's indeed a good price. We have seen the stock market going down. But the good thing is this. Now, we don't have to commit all our cash. We are a cash allocator. We are a capital allocator. We must know when to go in, when to go out. When there's higher certainty, when we are more sure, we should go in. But when there's data telling you that September may be a down month, there's no 100% guarantee it'll be a down month, but you know that based on historical data, it may be a down month. There's a chance. Why not hold it in cash? So this is the first thing that I will personally do, and so does most of my like investing members and investors around me. Now, the second thing that you can also possibly do is to do income trades. If you look at all the historical past data, the worst months, okay, in let's say October, in September, this month, right, you can see it's about 0 point something percent, 2% or 1%. You don't see a very huge dip like 7%. Okay, 7% is like there's no such thing. Okay, if you look at month on month, historically doesn't happen within a month. So what you can do is do trades like iron condors. Okay, what does iron condors do? Iron condors is an income trade, and what I suggest, in fact, these are my rules. We go out far in the market to actually create a particular situation, like a risk graph over here. If you don't understand about options, please learn about it. It's very powerful. Now, we can create income trade, and you can see this green portion is in the profit. We can make up to $400 over by risking 500. But the chance of risking that 500 is very low. Even though here put 52%, it is much lower. Let me show you why. You can see that for me to lose money, okay, look at this thing. The market needs to go all the way up by 4% within a month. You see, 4.2%. Or it goes down by 4.8%. And we have seen historical data shows that you don't see within a single month it goes up by 4% or down by 4%. Very few. In fact, I don't see any one of them here. So what it means is the chance of making money, it's really high. So this is one trade that we can take. Okay, so make sure that you pull the wings, okay, of the iron condor far so that you can get the income. Pretty good to make some income of like 400 or even 4,000, depending on your capital. So this is the updates that I have. And before I end this particular session, do like comment below. Like if you have any thoughts, you have any questions, ask me in this video right below. And if you like this video, give me a thumbs up, subscribe, and also tell me what other things you want to hear. I'll be giving lots of market updates because the market is pretty choppy right now. So I want to end by saying this: size is nothing, sizing is everything. Now, I hope that your mind is thinking about investing and not something else. But for investing wise, I've seen that huge capital, huge size portfolio, they become nothing if their position sizing is wrong. So if you position size correctly, I've seen portfolio of a couple of thousands of dollars turn into literally like tens of thousands, hundreds of thousands, and even millions if you size it correctly. So remember, the size of a portfolio is nothing. If it's small, don't be too concerned. If it's big, you're going to be concerned and you're going to do position sizing. So that's all. I do hope that this is valuable for you. I'll see you in the next video.